What if I told you that your second income, the one you drag yourself out of bed for every morning, the one that keeps you from your kids, the one that's slowly burning you out, is worth less than $4 an hour? Not $50,000 a year, not $25. $4. And that's if you're lucky. For some families, that second income is actually negative. You are paying to work. I'm going to prove it to you in the next 20 minutes, dollar by dollar, line by line. And when you see the final number, you are going to understand why so many dual-income families making over $100,000 a year feel like they are drowning. My name is Guru, and this might be the most important math you ever do.
Let me introduce you to Sarah and Mike. She is a marketing manager making $68,000 a year. He is in IT, pulling in $75,000. Combined household income, $143,000. According to the United States Census Bureau's 2023 income data, that puts them in the top 20% of American households. On paper, they should be crushing it, building wealth, maxing out retirement accounts, taking real vacations, feeling financially secure. Instead, Sarah eats a protein bar at her desk for lunch because they cannot afford to eat out. Mike lies awake at 2 a.m. doing mental math about whether they can fix the backyard fence this month. Last month, their furnace broke. $900 to repair. They put it on a credit card. On a combined income of $143,000 a year, they did not have $900 in cash?
If you have ever looked at your combined household income and thought, we make too much money to feel this broke, then this video is for you. Because today, I am going to do something that almost nobody does. I am going to take the second income and subtract every single hidden cost that comes with it, dollar by dollar, line by line. And the number that is left at the end is going to make you angry. But before we get into the math, I need to explain one economic concept that changes everything about how you see your paycheck. It is called the marginal tax rate. Most people think about taxes as a flat percentage. You earn $1, the government takes 20 cents, you keep 80. But that is not how the American tax system works. The United States uses a progressive tax system, which means each additional dollar you earn gets taxed at a higher rate than the dollar before it. According to the IRS's 2024 tax brackets, a married couple filing jointly with a combined income between roughly $94,000 and $201,000 falls into the 22% federal tax bracket. Here is why that matters for you. When Sarah takes her $68,000 a year marketing job, her income does not start at zero for tax purposes. It starts where Mike's $75,000 income ends, right in the 22% bracket. Her entire salary is being taxed at the marginal rate, not the average rate, and that distinction costs her thousands. Let us break it down. Sarah's gross salary, $68,000. Federal income tax at the 22% marginal rate on the majority of that income, approximately $10,200. Social Security tax at 6.2%, $4,216. Medicare tax at 1.45%, $986. State income tax, using a moderate 5% rate that covers most states outside of Texas and Florida, $3,400. Add it up. Federal, $10,200. Social Security, $4,216. Medicare, $986. State, $3,400. Total tax burden on Sarah's second income, $18,702. Before Sarah has spent a single dollar on anything, the government has already taken almost $19,000 of her salary. Her take-home pay is now $49,298. And most families stop the calculation right here. They think, okay, $49,000, that is still a solid contribution to the household budget. But we are nowhere near done. Let us talk about childcare. This is the number that breaks most families, and the one that almost never gets discussed honestly.
According to the Economic Policy Institute's 2023 analysis, the average annual cost of childcare for an infant in the United States exceeds $12,000 per year. For a 4-year-old, it is just under $10,000. In 28 states, according to their research, childcare costs more than in-state college tuition. Let that sink in. You are paying more for someone to watch your toddler than most Americans pay for a 4-year university degree. Sarah and Mike have 2 children, a 3-year-old in full-time daycare and a 6-year-old who needs after-school care during the school year and full-day camp during the summer months. Their total annual childcare bill? $18,000. Not because they chose the fancy daycare with the organic meals and the French immersion program, because that is what basic, safe, reliable childcare costs in their metropolitan area. According to Care.com's 2024 cost of care report, the national average has climbed to over $11,500 per child. For families with multiple children in care simultaneously, the costs are absolutely staggering.
So subtract $18,000 from Sarah's $49,000 take-home. She is now at $31,298. The second income that was supposed to transform the family's finances has already lost over $36,000 to taxes and childcare alone. Her $68,000 salary has been cut nearly in half before we have even accounted for the car. Here's a reality that single-income families do not face. When both partners work full-time in most American cities, you do not need one reliable car. You need 2. There is no negotiation on this. Sarah and Mike both commute to separate offices in completely different directions. Public transportation is not an option in their suburb. 2 cars are a non-negotiable absolute requirement of the 2-income lifestyle. According to AAA's 2024 Your Driving Costs study, the average annual cost of owning and operating a single vehicle in the United States is $12,182. That includes the car payment, insurance, fuel, maintenance, tires, registration, and depreciation. Sarah drives a used Honda CR-V, nothing extravagant. The monthly car payment is $280. Insurance is $140 per month. Gas for her 40-minute each-way commute runs about $160 per month. Oil changes, routine maintenance, and the occasional repair average out to about $100 per month. Annual registration and inspection add another $200. Sarah's total annual car and commuting cost, $9,500. Subtract that. She is now at $21,798. Next come the professional costs. These are the expenses that exist solely and exclusively because Sarah has a job outside the home. A professional wardrobe. Not designer suits from Nordstrom, but she cannot show up to client meetings in yoga pants and a hoodie. She needs blazers, blouses, professional shoes, and the occasional new piece when things wear out. Annual cost for the wardrobe? Approximately $2,200. Dry cleaning for those professional clothes, $600 per year. Lunch is at work. Sarah tries to bring lunch from home most days. She is genuinely trying. But 3 to 4 times a week, the morning is too rushed or she forgot to pack something and she grabs food near the office. $12 per lunch, 4 times a week, 50 weeks a year. That is $2,400 per year just on work lunches. Subtract $5,200 for professional costs and work lunches combined, she is now at $16,598. And now we arrive at the cost that nobody budgets for. The cost that does not show up on any line item on any spreadsheet until you look back at the end of the year and wonder where in the world all your money went. I call it the exhaustion tax, and it is real. It is massive, and almost nobody accounts for it. When both partners work full-time, especially in demanding professional careers, something has to give. Something always gives. And what gives is your capacity to make smart, optimized financial decisions. You are too tired to be frugal, too time-starved to be strategic. According to the USDA's 2023 Consumer Expenditure Survey,
Dual-income families spend 37% more on food prepared outside the home compared to single-income families earning the same total household income. Not because they are irresponsible, not because they do not care about money, because they are exhausted. Think about Sarah and Mike's evening. They get home around 6:30, maybe 6:45. The kids need dinner, they need baths, there is homework to help with, there are bedtime stories to read. By the time both children are in bed and asleep, it is 8:30, maybe 9. Sarah and Mike have not eaten yet. Neither of them has the energy to stand in a kitchen for 40 minutes cooking a meal from scratch. So they order DoorDash, or they heat up a frozen meal, or they grab takeout on the way home. 3 to 4 times a week. At $30 to $50 per order for a family of 4, that convenience food spending adds up to roughly $7,000 per year above what they would spend if one of them had the time and energy to actually cook real meals from scratch.
Then there is the cleaning service. Sarah and Mike used to clean the house themselves on weekends. Of course they did. But with both of them working 50-plus hours per week and desperately trying to spend some meaningful present time with their children on Saturday and Sunday, cleaning became the thing that had to go. They hired a service. $200 every 2 weeks. 52 weeks a year, that is $5,200. And here is a cost most people never even think to consider. The cost of not having time to be a smart consumer. When you are exhausted and time poor, you do not comparison shop. You do not wait for sales. You do not clip coupons or research the best deals on anything. You pay full retail price because the time and mental energy required to find a better deal simply is not available to you. Research published in the Journal of Consumer Research has shown that time-poor households consistently pay between 8 and 15% more for the same goods and services compared to time-rich households. Between the convenience food, the cleaning service, the takeout coffees, the last-minute Amazon orders because you did not have time to go to the store, and the general premium you pay for being time poor, the exhaustion tax conservatively totals $10,000 per year. Subtract $10,000. Sarah's second income net positive contribution to the household is now $6,598. But wait, we need to account for her time. The actual hours of her life that this job consumes. Sarah works 40 hours per week in the office, but like most salaried professionals in America, she regularly works 45 to 50 hours. Her commute is 40 minutes each way, 5 days a week. That is 6 hours and 40 minutes per week just sitting in a car. Factor in getting ready in the morning and preparing work bags, and her total weekly time commitment to employment is approximately 52 hours. Over 50 working weeks per year, that is 2,600 hours. $6,598 divided by 2,600 hours. That equals $2.54 per hour. Your second income is paying you $2.54 an hour. Less than a cup of coffee at Starbucks. Less than a gallon of gas in most states.
Now, Sarah makes $68,000, which is above the national median. What happens when we run this exact same calculation on a second income of $50,000? $50,000 is closer to what many American working mothers actually earn. The result is not just bad, it is devastating. $50,000 gross. Federal income tax at the marginal rate, approximately $6,800. Social Security, $3,100. Medicare, $725. State tax at 5%, $2,500. Total taxes, $13,125. Take home, $36,875. Childcare for 2 kids, $18,000. Second car and commuting costs, $9,500. Professional costs and work lunches, $5,200. Exhaustion tax, convenience spending, and the time poor premium, $10,000. Total hidden costs of the second income, $42,700. Net contribution, negative $5,825. Read that number again. Negative $5,825. Your second income is not paying you $1 an hour. It is not paying you anything at all. You are paying $5,800 per year for the privilege of going to work. Your $50,000 salary is completely underwater. You are literally paying to work. You are subsidizing your own job. And if that makes you angry, good. It should make you angry. But I want you to channel that anger into understanding. Because this is not a personal finance failure. You did not do anything wrong. Sarah and Mike did not do anything wrong. This is a systemic design. In 2003, Harvard bankruptcy law professor Elizabeth Warren, long before she ever entered politics, and her daughter Amelia Warren Tyagi published a groundbreaking book called The Two-Income Trap. After studying over 2,000 American families who had filed for personal bankruptcy, they discovered something that defied every piece of conventional financial wisdom. Dual-income families were actually more likely to file for bankruptcy than single-income families. Not less likely, more likely.
How is that even possible? How can two incomes make you more financially vulnerable than one? The answer is that the second income did not create surplus. It created a bidding war. When both partners in most American households started earning, they did not pocket the extra money and invest it. They used it to compete for a limited supply of the things that matter most: housing in safe neighborhoods with good school districts, quality childcare, college spots at reputable universities. According to the National Association of Realtors, the median home price in the United States in 1970, adjusted for inflation to $2024, was approximately $171,000. Today, that median price exceeds $400,000. The homes did not get 2.5 times bigger. The kitchens did not get 2.5 times nicer. The number of bidders doubled. When every family has two incomes become the minimum bid, not the competitive advantage.
College tuition has increased by over 1,220% since 1980, according to the Education Data Initiative. Not because the education got 12 times better, not because professors are 12 times smarter, because the pool of families competing for limited enrollment spots expanded dramatically when the second income became the social norm. The second income became the new baseline. And once it became the baseline, every major cost category in American life adjusted upward to absorb it. You are not getting ahead with two incomes. You are running to stay in place on a treadmill that gets faster every single year. So what do? If the math shows that the second income is worth somewhere between $1 and $3 per hour after taxes and hidden costs, and in many cases is actually negative, what is the move? What is the actual strategy? I want to introduce you to a framework I call the One Income Foundation. And I want to be very clear about something up front. This is not a video telling you to quit your job. This is not about going back to the 1950s. This is about restructuring how you think about your household finances so that you stop being trapped and start building real wealth.
Here is how the One Income Foundation works. You take your household and you identify one income, just one, as the foundation, the anchor. Let us say that is Mike's $75,000. You build your entire fixed cost structure around that single number. Your mortgage or rent gets sized to fit one income. Your car payment, your insurance, your utilities, your groceries, your baseline lifestyle, every single fixed cost gets recalibrated to fit inside one paycheck. Then Sarah's income, the entire thing, gets treated as if it does not exist in your day-to-day budget. Not 90% of it, not 80%. 100% of her income gets redirected directly and immediately into savings, investments, or aggressive debt payoff. It never touches your operating budget. Now, I know exactly what you were thinking because I have heard it 1,000 times.
We can barely survive on 2 incomes. How are we supposed to live on 1? And here is the critical insight that changes the entire calculation. You're not actually living on 1 income. You're living on 2, but you are intentionally structuring your life so that if 1 income disappeared tomorrow, your financial life does not collapse. Whether through job loss, a health crisis, burnout, a decision to stay home with aging parents or young children, whatever the reason, your financial life does not collapse.
According to the Bureau of Labor Statistics, the median duration of unemployment in the United States is approximately 22 weeks, nearly 5 months. If your entire financial life is built on the assumption that both incomes will always be there and one disappears, you have maybe 2 to 3 months before the financial pressure becomes unbearable. Credit cards start filling the gap, the debt spiral begins, and the trap that was always there becomes inescapable. But if you have been running the 1 income foundation for even 2 or 3 years, the math changes completely. And this is where it gets exciting. Under the 1 income foundation model, many of those hidden costs we calculated earlier shrink dramatically or disappear entirely. If Sarah's income is being redirected entirely to savings rather than supporting the household budget, she might reduce her hours. She might find a position closer to home. She might negotiate remote work 2 or 3 days a week. Suddenly, the second car is not needed every single day. Childcare needs decrease. And the exhaustion tax, that $10,000 annual penalty for being too tired to make smart decisions, practically evaporates when one partner is not running on fumes every single day.
Let us be very conservative with our numbers. Let us say that after restructuring their lifestyle under the 1 income foundation model, Sarah's second job contributes $25,000 net per year to investments and savings. That is a fraction of her gross salary. But it is a massive, transformative improvement over the $6,500 we calculated earlier. And it is infinitely better than the negative number we got with the $50,000 scenario. $25,000 per year, invested consistently in a diversified portfolio. According to Vanguard's 2023 research on long-term portfolio performance, a balanced portfolio of 60% stocks and 40% bonds has returned an average of 8.3% annually over the past 30 years. The historical average annual return of the S&P 500, adjusted for inflation, is approximately 7%, according to decades of data compiled by Aswath Damodaran at NYU Stern. At a conservative 7% real return after inflation, here is what $25,000 per year becomes. In 5 years, $154,000. In 10 years, $362,000. In 15 years, $654,000. In 20 years, over $1,100,000. That is not speculation. That is not a get-rich-quick fantasy. That is 7th grade mathematics applied to over 100 years of stock market data.
And that money is not just sitting in an account collecting dust. It is generating its own income through dividends and capital appreciation, compounding, working for you 24 hours a day, 7 days a week, 365 days a year. No commute, no childcare bill, no exhaustion tax, no boss, no deadlines. Within 5 to 7 years of consistently following this approach, something genuinely transformative happens. The investments you made with that second income start generating meaningful returns on their own. Your money is making money while you sleep. And suddenly, you actually have what you thought dual incomes were supposed to give you in the first place. Real, tangible, honest-to-God financial security. Not the appearance of security, not the Instagram version of prosperity. The kind where you lie down at night and you actually sleep well, because you know that if everything went sideways tomorrow, if both jobs disappeared, you would be okay for months, maybe years. The families who thrive financially in the modern economy are not the ones who earn the most. They are the ones who have preserved their flexibility, who have refused to let their expenses expand to consume every dollar of income, who have kept their backup plan in reserve instead of deploying it just to keep up with the neighbors.
I want to leave you with one final thought before we wrap up, because I think it reframes this entire conversation in a way that might change how you see everything. The two-income trap is not really about income. It is about flexibility. It is about margin. It is about having options. Our grandparents, living on a single income, had something that we traded away without even realizing it. The ability to absorb a shock, to change direction, to have one partner step back and focus on raising children or caring for aging family members without the entire financial structure of the household collapsing. We traded that flexibility for bigger houses, for nicer cars, for the appearance of prosperity. But appearances are not wealth. Cash flow from a job is not security. And two incomes are not better than one if both of them are already completely spent before they ever arrive in your bank account. You now have the math. You understand exactly where your second income goes. You know why the trap exists, and you know the escape route. The one income foundation is not easy. It requires short-term sacrifice and the discipline to ignore social pressure. But the math does not lie. The question is what you are going to do with this information starting this week. If this video changed how you think about money, check out this video right here where I break down exactly how much you actually need in your emergency fund, because that number might surprise you. I will see you there.